You were at 45,500 at the beginning of May, which was not even close. I was at 40,000, which was still not even close. We took quite a big dip, and we're hovering around 30,000 as we speak. So
all right, and just like that, we are back again with the Mind the Growth podcast. As always, I am Chris Kinghorn.
And now I'm Eric Hoffman.
Eric,
What's going on?
It's not well. Things are not well. On all, the everything bubble is popping. I'm freaking out. How are you doing?
I'm hanging in there. My portfolio is not hanging in there much, but I'm doing okay. I think I just
stopped looking at it. I just stopped looking at it. I figure as long as I don't see what's going on, it won't hurt me. Is that a bad mindset to be in?
No, I think that's probably the best one to be in. But
all right.
we got a lot to talk about, and we're going to do a bit of a short one today just to give the people what they want, the high level info. So what I think would be good for today is we're going to talk about two of our favorite things, crypto and real estate. Starting with crypto, unless you're living under a rock or don't care about crypto, there's a big news story over the past couple of weeks, and that was a company called Terra Luna. Do you know about this, Chris?
I do. Before we dive into it, I think it's important to announce which direction we're going to. We are going into the corner, the crypto corner. Part one of today's episode is the crypto corner. I do, and I heard there was something where they had to be backed by something called Bitcoin to some extent, where they had to own a certain amount of Bitcoin to kind of peg their valuation to a stable coin around $1. Am I onto the right thing here?
Yeah, kind of. So the theory behind this protocol was it's referred to as an algorithmic stablecoin. So to give the listeners an idea of what a stablecoin is and what its use case is, and I want to be clear, I'm not an expert. I don't know much, but I do follow the news and I find this stuff interesting. So take that with a grain of salt. But my understanding of what this is, a stablecoin was created initially to basically subvert your ability to go from crypto to fiat. So for instance, when exchanges first came online, like a Coinbase, like an FTX, like a Gemini, originally, if you wanted to purchase crypto, you would have to wire money into your account or use, some sort of ETH method to, you had to get money into your account from your bank to be able to purchase the crypto. So what that means is you'd put money in US dollars in our case, and you'd buy whatever cryptocurrency you want. The problem was when you sell that crypto to buy another coin, then what happens is you would incur a capital gains tax if it went up, or, obviously the reverse. If it went down, you'd, have some sort of tax savings. But rather than having to do that, because there's a lot of people who are trading frequently and, using those professional platforms to trade every day, and that would be a huge headache to have to account for in terms of taxes. So these stable coins were created to keep you in the crypto ecosystem. So rather than selling Bitcoin and translating that into a fiat currency like US dollars, you would sell that into, let's just say, USDT, which is Tether. There's been a lot of controversy around Tether in the past. That was one of the first stable coins. More recently, there's another one called Circle, a company that issued a USDC. It's a Circle stable coin. These two stable coins in particular, they are in the traditional sense backed one-to-one by US dollars in their bank account or some version of that, whether it's bonds or something else that they have. Tether, there's been a lot of investigation around Tether, the company itself, because they were early on pretty secretive about what their reserves actually are. And so there's been a few times where that one-to-one dollar peg has been compromised and it's gone down, but they've always regained it and it's been pretty stable throughout its life cycle. USDC, on the other hand, that was a big venture-backed stablecoin company that they claim, and they're audited, that they have one-to-one US dollars to every USDC that's issued. So that's the traditional sense of what a stablecoin is and its purpose. More recently, there were new companies like Luna that wanted to create what's called an algorithmic stablecoin. So rather than having one-to-one backing of a fiat to the cryptocurrency that they issued, the stablecoin, they had an algorithm that basically balances between two different coins. So they had a coin referred to as Luna, and they had a coin referred to as Terra. And so between the two, it was UST, which was the Terra part. That was the stable coin. And there was a one-to-one relationship between Terra, UST, and Luna, the cryptocurrency. And every time you basically took a Luna token and converted it or burned it, it would create a USDT, which ultimately, long term, the whole purpose of that algorithm is to burn all of the Luna tokens and create only UST. And so, from a holder's perspective, you'd want to hold Luna and basically back UST because it's constantly going down in volume. So the more Luna that's burned, the more UST that's created. There's supposed to be a balancing act there, and that's where the algorithm comes in. More recently, they decided to back the whole protocol with Bitcoin and other cryptocurrencies because there were a lot of talks about how somebody can, make a bank run. Like for those history buffs, George Soros, he famously broke the Bank of England by doing something like this, where he created a bank run, a hype cycle where everyone went to the bank and basically took out their money because they had fears that the pound in England at the time was going to collapse. And so the value went down tremendously. Same idea here. Somebody, and eventually this happened, somebody could take a lot of money and create a bank run in the Luna ecosystem and collapse the entire mechanism. On top of that, the reason that it became so big, and I think at the time when it was its biggest, it was around $30 to $50 billion of total market cap, the entire company. But they had this protocol called Anchor, where you can basically stake your UST, the stable coins, and they had a perpetual 20% interest if you held your money in that Anchor protocol. That's a huge deal. If they're guaranteeing 20% on your money, people are going to flock to that. And it just got bigger and bigger and bigger. I think in April, they wound up reducing that to 18% because it got so big that it just wasn't sustainable. They were losing money by paying out those interest rates, every day. And so they moved it to 18%. But the founder, this guy, Do Kwon, was hyper confident, and he just would continue on his path and not make many changes. Ultimately, I'll share my screen here. At the beginning of May this month, the entire system collapsed. Somebody made a big bank run on the UST, and everyone started selling. The one-to-one ratio depegged. I think it went originally to like 98 cents. Everyone freaked out. It dove to like 70 cents after that, went back up after they sold a lot of their reserves, which are in Bitcoin primarily. So they sold at one point like over $1 billion worth of Bitcoin. So that also had a cascading effect where Bitcoin's price went down because there was a huge sell pressure on that. And when there's a lot more volume in the system, the price is going to go down because there's more sellers than there are buyers. So when you sell a huge amount of a currency, it's going to go down. So this entire shenanigan basically took down the entire crypto market. This article says here $1 trillion was lost essentially in the last several weeks as a result of everything that's going on. And on top of that, we just have a down market anyways. So it was the perfect storm of a haywire system going crazy, and we wound up here. So this guy John Woo, I follow on Twitter. he had probably the best explanation of what happened. So I highly recommend anyone that's curious to go look at his thread here on Twitter, which we can include in the show notes. But he basically explains a high level view. He's incredibly smart. And that's where I took my information. So if I said anything out of turn, out of line, or just plain inaccurate, refer to John, because I don't know what I'm talking about. But that's the story in a nutshell. What do you think?
I think it's crazy. And one thing I do want to kind of take a step back and explain to people. People are thinking, okay, why do you get into specific coins? Why do you get into Bitcoin? Why do you get into Ethereum, Cardano, Solana, Avalanche, Chainlink, Polygon? You can go on and on of all the coins. But these stable coins were so attractive to people because of this, like you said, 20% return. There's some of them that have been averaging about 12 for the last handful of months, where there's people that have really refinanced their houses or pulled everything out of their bank accounts and dumped their money into stable coins because they knew that they were going to get a quote unquote guaranteed 5, 10, 8, 12, 15, 20% return. And for this project to just come crumbling down, I think what it's going to do is it's going to spark a need for regulation, which I think ultimately people hear regulation in crypto and it starts scaring people off. But ultimately, it's going to be better for the crypto ecosystem if there is some sort of sense of regulation. And I think as we get more of a consistently regulated, but not over regulated ecosystem, that's going to bring in more institutional funds. That's going to bring in more and more people into this because it's going to feel safer. Because it feels just like a big rug pull. So it brings people back to almost, in a sense, being scared of crypto. But I think a lot of people got greedy. You can't.
For sure.
I get that you want these massive returns, and people get into your Shiba Inu or your Dogecoin because you put in $1,000 and a year later you luckily become a millionaire, or 10 million, 10, 10, 20, $30 million, whatever that could turn into. But it comes down to when something's too good to be true, it probably is too good to be true. And there's people out there that are smarter. There's always somebody smarter out there. And as soon as somebody gets real smart, real greedy, and has enough money to do this and take this down, it'll happen. So it's sad for the people that lost money. But in my opinion, that's why you invest into solid existing projects that have been around. That's why I like Bitcoin. That's why I like Ethereum. I love Cardano. For all the ADA gang out there, there's probably some people that are like, what the hell, you like Cardano? But that's my overall thoughts on it.
Yeah, great thoughts. My main takeaways from it were, I agree with you. This is basically a guarantee that there's going to be some form of regulation that comes out as a direct result of what happened here. Because, this is billions of dollars just lost overnight, basically.
Trillion, almost, or if not, just at a trillion.
In the total market. That also includes just the downturn in the market in general. But yes, a lot of money lost pretty quickly. So the regulators are going to jump all over it, which is both fortunate and unfortunate, because when the regulators get their grubby hands on something, they like to get as much power as they can. Not ideal, but I think there could be some good forms of regulation. Hopefully we'll see the latter.
Well, let me stop you on this too, because I do want to give you one other point, and why I think this also highlights why we might not necessarily need regulation, and why crypto is done such a good job as what it's done. Could you imagine in the traditional banking system if there was billions, if there's $100 billion, $200 billion, if there's $1 trillion worth of value that's lost over you call it a 6-week time frame, the traditional banking system would have collapsed. So it's a testament of how solid, if you will, the cryptocurrency ecosystem is. But it is sad that a lot of this is just going to be retail traders that got hurt. So
yeah, good point. And I think the irony to that statement is the Federal Reserve and politicians have gotten so savvy on how to market things and position things in particular. I would argue that, the trillions of dollars that have been injected into the economy over the past 2 years have actually in net lost trillions of dollars of value across the entire ecosystem of our economy, because everything's worth less and everything's getting more expensive. So just that one move basically did far more harm than this protocol collapsing, even though it was positioned as helping people. So, You can market it in different ways, but it's ultimately the same problem. That's my 2 cents about government overreach and the poor financial mistakes of the Federal Reserve. But that's for another episode. The only other thing I want to mention on
that's inflation talk. We're not going into inflation talk yet.
The only other thing I'll mention,
watch.
Exactly, on this topic before we get into real estate is I do think that the idea of an algorithmic stablecoin is interesting and unique, and long term, I think somebody will probably find the right code to be able to stabilize something like this without the backing of, hundreds of billions or trillions of dollars for an eventual stablecoin to exist like that. So I'm all for these things being tested and them exploding if they don't have the right people or setup. So the problem is people lose a lot of money, and everyone that I talk to that ever asks me about crypto and investing in crypto, the first thing I tell them is expect to lose everything that you put in. And this is the exact reason why. So if you don't go in with that expectation, then I think you're just setting yourself up for failure anyways. But the hope is that you can get on board with maybe an early project that you believe in, that you research, that you do due diligence on, and ride that wave to your rags to riches story. But at the end of the day, be aware that it could all be taken away within 24 to 48 hours. That's my spiel.
It's a good spiel. It's true. Yeah, I think that I had somebody actually who asked me last night about investing into crypto and how they should do it, and it brought up a few different coins, and I was like, well, what do you like about that coin? And they had one or two just quick Google responses of, I like Ethereum because there's NFTs on it. I'm like, well, there's a lot of other platforms that have NFTs as well too. So I just think and not financial advice, the best way to do it is put a little bit of money into Bitcoin and then start getting your feet wet. As soon as you invest into something, you're vested, and you are going to want to learn about it, and you're going to want to spend more time, and just keep researching. And as soon as you think that you're ready to place money into their first or second project, do as much time as you did the first time researching again. And if you still have the same conviction level, then go ahead and do it.
Right. I think that's a good play.
Yep.
All right. What's going on in the real estate market, Chris?
Well, interest rates are going up. Housing prices are somehow still going up. Money is getting harder to get, and houses are still getting harder to get, which it doesn't make sense. I think it's location-wise. I think a lot of it has to do, especially here in Phoenix, there's just such an influx of people, and it'll be interesting to see kind of what that supply and demand curve continues to look like. We're going to have to top out eventually. The growth has just not been sustainable. What else has not been sustainable is the apartment prices, and there has been a little bit of a softening of a market and a little bit of a stabilization, but we're still seeing some of these extremely high watermarks on more of the luxury, just really great location, those style of apartment complexes, 100 to 300 units, and they're selling for over $700,000 to over $700,000 a door. That's your LA prices at that point. It's absolutely not sustainable, but it's still going on. We're also seeing other buildings that are maybe a little bit more of a value add or a 90s or an 80s style construction. Those are starting to soften a little bit, and we're actually getting a little bit of a correction on the pricing and the cap rate. So that market seems to be slowing down a little bit, but I think long term it'll stay fairly strong. It comes down to just the capital markets. There's been a lot of conversations with sellers and buyers of understanding the structure of debt, the new amount of equity that's going to be needed, et cetera. So it's an interesting time, but I know there's kind of one that you wanted to look at specifically, or two of them.
Yeah. So what brought this up to me, I saw an article come out, I think yesterday or the day before. We're recording this on May 17th. And it was this apartment complex that I believe you currently live in. It's called The Modern. Yeah. And it's just sold for, I think, $260 million. And that equates to a little over $700,000 per unit, which I thought was absolutely insane. and just a wild price to see. My head almost exploded when I saw the report of it. So tell me your thoughts on that, because like you said, these are now LA prices, and sustainable or not, it's happening. So I mean, I'm not a huge multifamily investor, although I have some money in there, but do these people just not know what they're doing? Do they know what they're doing? Do they know something we don't? What's happening?
So it's funny. There's on Camelback Road, there's the Optima apartments, and not the condos, but the apartments just southwest of Scottsdale Fashion. And a few years back, those had gone for just some ridiculous number. It had blown the last comp just absolutely out of the water, and everybody looked at that company as if they were crazy.
Yeah.
And now it seems like one of the smartest plays they could have ever done. There's a smaller complex just east of the Modern that recently sold to. It sold for $756,250 a door. It was a $121 million purchase price, so it was a smaller building than what the Modern is, but just that number for the amount of units it's in an amazing location. I recently bought a house, so I can't wait to get the hell out of there. But for what it is, it's a good place.
Yeah.
But they did. So we've got a 1-bedroom, 1-bath, and we pay like almost $2,200 a month for it. They were going to bump our base rent to over $2,500 a month. So we're getting to another thing with rent growth. Rent growth has been year after year, like 15 to 19% within the Valley. With some of the luxury apartments, I think it's gone up a lot more than that. So getting to the point of sustainability on rent growth as well too. But as housing prices have gone up, having that down payment, and now that interest rates have gone up too with the monthly mortgage payment, they might have some more room, a little bit more of an argument to continue to increase those. But ultimately, I don't know. No one's got that crystal ball. I think we're technically, because the GDP hasn't came out for Q2 just yet, we're not in a recession, but I think we're definitely in a recession. Job growth, we'll see if that starts to go down, if some of these companies start pulling back. So are people really going to be able to afford these? Is vacancy going to start increasing a little bit and causing some of these landlords to lower their prices a little bit? But if you buy something at just some ridiculous price point, the only way to really make that work is to have extremely high rents. So I don't know. I wouldn't look at myself as an expert at this right now. If somebody knows something else that I don't, leave it in the comments, because it's crazy.
Yeah, I think we're going to get Mikey on maybe we'll have to ask him to give us a brief lesson and share some analytics on something like this, because I wonder what average rent would justify that price, over 700,000 a unit. Are you looking at, 3,500, 4,000, 4,500 on average rent in that complex to justify that price? What's the end goal, and how do you actually make money on that? So that would be my curiosity. We'll have to shout out to our friend Mikey. We'll have to get him on and give us some analytics on that. But super interesting. We're in some wild times here, and I'm excited to see it play out. Last thing before we go, I looked at our last discussion on crypto, and I reviewed our predictions. So
I think you won that one. Yeah.
Well, you were at 45,500 at the beginning of May, which was not even close. I was at 40,000, which was still not even close. We took quite a big dip, and we're hovering around 30,000 as we speak. So it's looking like we're in a pretty deep bear market right now. Not sure if we'll dive even further. There's some people that say we're going to head down to the 20,000 range and see our friend Michael Saylor get liquidated for everything he's worth, because he has a margin call at 21,000 for those who are watching. So we'll see.
Is he going to have to sell that? He's going to have to sell the sailboat that he's got behind him in all of his videos.
Yeah. So we'll see. There's room for it to go down further, but if anyone has dry powder out there, it's a great time to buy. But I'm pretty sure most people are fully invested at this point and hemorrhaging.
I agree. Well, this
Godspeed,
has been a very
everyone.
fun segment of Crypto Corner, Inflation Watch. Real estate's getting priced to hell.
Yep. All right. Until next time. Hope you survive the winter, everybody.
Cheers, and we'll talk to you soon.
Bye.